Hello, welcome back to another video. Take every indicator of your chart. The moving averages, the RSI, all of it. What's left is the only thing price has ever done. It makes highs and it makes lows. The way those highs and lows connect is called market structure. It's over 100 years old. It works on every market and every time frame, and it's the skeleton that every indicator you've ever used is just a delayed reflection of. In the next few minutes, you'll learn to read it. Price never moves in a straight line. It breathes. It pushes forward, pulls back, and pushes again. Each turning point is called a swing. A swing high is a peak with lower highs on both sides of it. A swing low is a dip with higher lows on both sides. That's it. Ignore the noise between them. The swings are the sentences. Everything else is just letters. Once you mark the swings, every market is only ever doing one of three things. In an uptrend, each high is higher than the last and each low is higher than the last. Higher highs, higher lows. Buyers are winning. In a downtrend, it's the mirror image. Lower highs, lower lows. Sellers are winning. And when price makes neither, when it just oscillates between the same levels, it's ranging. Nobody's winning, and the market is building energy for its next move. Charles Dow described this in the 1890s. It hasn't stopped working because it isn't a trick, it's the definition of a trend. Now the market starts talking to you. In an uptrend, watch the most recent swing high. When price breaks above it and makes a new higher high, that's called a break of structure. It means buyers were strong enough to take out the old ceiling. The trend just voted to continue. As long as the market keeps breaking structure in the same direction, you have no business fighting it. But here's the moment that matters most. The uptrend pushes up and fails, no new high. Then price turns around and closes below the last higher low. The one level an uptrend must never lose. Traders call this a change of character. It does not guarantee a reversal. It's a warning shot. The pattern that defined the trend is broken and the burden of proof just flipped. This is where you stop buying every dip on autopilot. And now, the mistake that costs beginners the most money, treating every poke through a level as a break. Think about what sits above an old high. Stop losses from everyone who is short and breakout orders from everyone waiting to buy. That's a pool of liquidity, and large players know exactly where it is. So price often spikes above the high, fills those orders, and reverses hard. That's a liquidity sweep, a stop hunt. Here's the rule that filters most of them out. A break only counts when a candle body closes beyond the level. A wick that pierces it and snaps back is not a break. In fact, it's often a signal in the opposite direction. One more layer, and this one resolves a confusion almost everyone has. The trend is up on the daily and down on the 15-minute. So, which is it? Both. Structure is fractal. Every pullback on a high time frame is a complete downtrend on a lower one, with its own swings, its own breaks, its own character. So professionals split the job in two. The higher time frame answers one question: which direction am I trading? The lower time frame answers the other: when? You wait for the daily uptrend to pull back, then watch the lower time frame until its little downtrend breaks its own structure to the upside. That's the higher time frame trend resuming, caught early with a tight stop. So here's the honest part. Market structure will not tell you the future. Nothing will. What it gives you is something better, a framework that defines exactly where you're wrong. If you're long an uptrend, the last higher low is your line in the sand. Below it, your idea is invalid. Not maybe, not emotionally, structurally. Trade in the direction of the structure, enter after pullbacks confirm, and put your risk behind the swing that must hold. Do only that, and you're already reading the chart better than most people who've been trading for years. That's market structure, highs, lows, and the story they tell. In the next video, we'll take this skeleton and add the first layer of flesh, where exactly inside a pullback price is most likely to turn. Subscribe so you don't miss it. Till the next time, take care, don't be greedy. If you enjoyed this video, don't forget to give it a like, share, and comment.